is that the European and the UK market spiking. Why? Because of something that potentially might happen the other side of the world. Australia, prospect of a possible strike at an LNG, liquefied natural gas plant in Australia, pushing the wholesale gas prices up in Europe. The Offshore Alliance Union warning that a strike in the Northwest Shelf facility could start as early as the 2nd of September if no deal on pay is reached. Let's get some insight on this one from the global energy expert himself, Carnegie Endowment. Live from Washington this morning, Justin Dargin. Good morning to you, Justin. So issues in Australia having an impact on markets worldwide, but which markets will be most at risk of this potential strike?
Well, that's a very good question. So if you look at it structurally, of course, it would be the Asian market, because the Asian market is the one which imports the actual LNG from Australia. So most of the LNG from Australia. So if you look at Japan and South Korea, so structurally, they would have some issues in terms of potential shortages if there were any type of long-term industrial action. But this, I think, is a testament to the interconnectedness of the LNG market. And this has been ongoing, we could say, over the past decade or even past 15 years, whereby the LNG market has taken on the characteristics of the global oil market at the same time. So LNG has become much more fungible. And then also you see the creation of this financial apparatus as well. So through the spot market that has been created, which makes the LNG market much more finely tuned. Therefore, when you look at the EU, for instance, where it diversified quite substantially away from Russian natural gas from about 40% over about 2 years ago to about below 20%. But at the same time, it has been relying much more on LNG imports, which leaves it much more vulnerable to volatility in the LNG market.
Worst case scenario, are there alternatives? Are there alternative resources and reserves?
Well, yeah, actually, the EU has made just great progress in terms of filling up its storage capacity. So it has reached ahead of schedule, actually several months ahead of schedule, its goal to put about 91% to fill 91% of its LNG, of its natural gas storage capacity. I mean, so the EU is in a much better place than it was last year, where it just barely scraped by due to the mild winter. But at the same time, the natural gas that the EU has in storage only represents about a third of its winter demand. So at the same time, if the EU does not necessarily have a mild winter such as it had last year, then we can see some potential problems. But the decarbonization efforts and renewable energy investments have actually been increasing in the EU. And as a result, we've seen about 12% decline in natural gas demand in the EU. And this is due to energy efficiency policies that have been implemented and then also renewable energy that has been deployed.
Potential and opportunity here for Middle Eastern suppliers to take advantage?
Oh, absolutely, absolutely. So what we can see is that Qatar is going to be in a much more favorable position. So we can see the formation of a type of seller's market. So Qatar and even the UAE would be able to, let's say, have a much more stronger negotiating position. And then at the same time, of course, you look at the increase in prices, which would benefit the UAE and also Qatar financially. And then lastly, we can see that this would also segue into the more geopolitical aims of many of the Gulf countries as they pivot to Asia. So what you find is that with increased collaboration and increased energy trade with China and also Japan, this also fosters a type of geopolitical, let's say, alignment as well, which works in the favor, of course, of many of the Gulf countries, the LNG exporting Gulf countries.
30 seconds left with you, JD. Just a quick one on us. Is it going to impact energy bills, business bills the world over?
Yes, it will, but it won't impact it as it did last year. I mean, simply due to the fact that the Asian countries, they were able to quite expeditiously implement many policies that were able to save them more or less from having any types of major shortages, and also in Europe as well. So there will be an increase. And if prices stick at a relatively high level due to a prolonged strike, then the European European consumer could potentially face about $13 billion in cost. But it definitely won't be where the EU was last year. And so the EU and the Asian market would be the most, let's say, impacted by more prolonged industrial action.
Justin, appreciate your time this morning. Thank you very much indeed. Apologies for the gremlins in the system a little earlier on, but we've got that one sorted. That's Justin Dargin, the global energy expert for Carnegie Endowment, live from Washington.
100 days to